Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week on the podcast, it seems a good opportunity to take a look back at what's happened so far this year and also where we might be heading. And I'm delighted this week to be joined once again by Emma Bird, who is the Head of Investment Trust Research at Winterfloods, now part of Marex Financial, following their acquisition, which completed at the end of last year. So, Emma, very good to have you on the podcast once more. Let's kick off by just talking about where we are in the cycle, in the grand scheme of things. At the half-year stage, the Investment Trust Index was up around 10%, which is very much in line with the long-run return from equities, and slightly ahead of the FTSE All-Share Index. So I guess it's been a story really of consolidating the recovery that happened last year. I think that might be a way to sum it up. Average discount is still around, I think, 11%, something like that, which is not significantly narrower than it was, but it is an improvement on the worst we've seen in the last 2-3 years. So how would you sum up where you think we are so far in the investment trust cycle?
So the first half of 2026, we did see some discount narrowing pretty much across the board. Generally, I think that has been driven by board action in a lot of cases, whether that's increased buybacks or increased use of other discount control mechanisms such as tender offers to help support the rating of the shares, as well as continued M&A activity or proposed wind downs and ongoing shareholder activism as well. So we have seen some discount narrowing that's supported the overall share price performance of the sector. And as you said, the current average discount of the investment trust sector is now around 11%. So definitely narrower than we saw at the kind of worst point of mid-2025, but still a lot wider than it has been historically in the lower interest rate environment of early 2020s and before that, where discounts were in low single digits.
You mentioned, of course, this is 11% average discount in a sector that is reduced in size quite significantly. We lost a significant number of trusts through that M&A activity, wind-ups, mergers, and so on. And the amount of shares outstanding has also reduced because of all the buybacks, as you say, that have been going on. I think the rate of buybacks has slowed a little this year, though obviously looking back over several years, it's still very high levels. Would you say there are still some boards that haven't had the memo about how to deal with this mismatch between supply and demand? A bit behind the curve still, would you say?
I think it probably is fair to say that there are still some boards or some investment trusts that could do more. But I think in general, we have seen a big improvement in recent years of boards taking action. And I don't think that just buybacks is the answer for boards addressing a mismatch in supply and demand, particularly for illiquid assets, whether that's real assets or smaller companies. I think you have to be careful of the underlying illiquidity of the holdings if you are having strict discount control mechanisms. But having said that, a sustained wide discount, particularly one that's wider than peers across a cycle, is a sign that there is potential lack of demand for strategy, and boards should review that and potentially undertake a strategic review or more drastic measures than just try and continue buybacks.
And would you agree that the main area of focus for that particular issue, the sort of discount control mechanism, is still predominantly focused on the alternative sector at the moment? I don't know if you agree with that. I mean, many equity investment trusts have come back into a kind of 5-10% band, some better than that, some not so good as that. But generally speaking, they've improved. But there's still quite a lot of work to do on the alternative side. What do you think there the main factor is? We know that there's always been a correlation with interest rate movements. We haven't had the interest rate cuts that some were hoping for this year. In fact, if anything, a little bit of hardening of bond yields. So in that sort of environment, are you thinking that it will take some time for the alternatives to get their discounts back in again? They're obviously much wider than 11% in many cases, out in the 20s, 30s still.
Yes, as I said, the overall average sector discount is about 11%, but as you mentioned, that does hide a big difference between long-only equity funds and alternatives, so primarily real assets, where the discounts are much wider, including quite a number of double-digit discounts there. The alternative sector, we normally do group it into one, but there are some key differences between the different alternative sectors, I would say. So property is one area, infrastructure and renewables, and private equity would be the three main alternative asset classes within the investment trust structure. And all three of those are very interest rate sensitive, as you mentioned. So the Iran war and the increased uncertainty that's added to the path of interest rates, I think, is continuing to weigh on discounts in these sectors. And I think that there needs to be a clearer path to see some material re-rating there. But I would say that in the property sector, we have seen a lot of corporate activity that is providing somewhat of a floor under those valuations. So we aren't seeing discounts as wide there. And that sector within the investment trust universe has shrunk a lot, with funds either winding down or being taken over by private equity or non-investment trust listed REITs. So I think that the consolidation there might be more. There's some ongoing at the moment, but generally I think boards have acted there. And I think we have seen more corporate activity in the property sector because I think investors are more certain on the underlying valuations. The NAVs are based on independent valuations, based on transactions in similar assets. So I think people have more faith in the underlying assets and what the true discount is, whereas we've seen less activity in the private equity and infrastructure space, although we are starting to see more there. So I think we are seeing boards waking up to the fact that these wide discounts are not sustainable and they aren't just a feature of the sharp interest rate rises of a few years ago. So I do expect to see some more consolidation there as a way to address the discounts, as well as the interest rate backdrop helping as well. But because of the illiquidity, I don't expect just kind of buybacks to be the answer there.
In that particular case, you might come back to commercial property, because obviously that was the sector that you used to cover before you stepped up to be head of investment trust research. We might come back to that because I think that's an interesting sector at the moment. One of the interesting things that you've been doing recently is you've been talking about the ability you have to look across the market, in particular at what retail investors are doing, private investors are doing. As a market maker, you can see quite a lot of the whole market, and you make up markets of a lot of the instruments as well. And you've published some interesting stuff about the patterns of retail demand, what retail investors are buying and what they're selling. We might talk about what that shows in a second. But overall, just to ask you a general question first, are you seeing any revival in demand at the margin from either that source or from institutional buyers as well? What's your take on the overall picture at the moment?
Across the whole investment trust sector, it really does vary by sector. So we are still seeing some pickup in interest from individual retail investors. Renewable energy infrastructure so far in 2026 is the most popular in terms of retail inflows. I think that's partly because of the attractive yields that these funds offer, as well as there being a tangential link to the AI theme in terms of the need for increased power to power the data centres. So I think that's an interesting thematic that's led to significant retail inflows. Sticking on the kind of AI related theme, Asia Pacific equity income and global emerging markets have also seen high amounts of inflows pretty consistently throughout the year, except for potentially in March around the Iran invasion when most sectors saw outflows. Although, interestingly, in July, the global emerging market sector did see net outflows for the first time in a number of months. So potentially seeing some concerns there over the valuations of some of these chip makers. Debt, the loans and bonds sector, again, we are still seeing a demand for income from sectors like that from retail investors, despite overall interest rates still being high. And then on the other side, I think the main areas we've seen outflows from are general global funds, so particularly driven by the large funds such as Scottish Mortgage, Alliance Witten, we're seeing outflows from there, other than a bit of month of inflows, particularly into Scottish Mortgage around the SpaceX IPO interest that we might come on to later.
Yes, well, that's been a big factor. I mean, the AI story has dominated a lot of the narrative and created, obviously, quite a lot of volatility as well. I wonder whether you think that the retail demand is coming from people who want to get exposure to AI, wanted to get exposure to SpaceX and AI, or in terms of emerging markets, whether it was more about just trying to migrate away from the US and the Mag 7 and so on, the concentrated US market Do you have any kind of insights on that? I mean, I imagine that SpaceX was a big draw for a lot of people, but they would have probably been quite disappointed by the aftermath, even if it wasn't a total surprise to some of us that the IPO valuation didn't last for very long.
Yeah, I think SpaceX was definitely an important part of the story for a number of individual investment trusts. I think it was widely promoted in the media that this has been a key way to get access to the company when it was unlisted. And then in terms of global emerging markets and Asia Pacific, it does seem that at least a part of that is a way to get exposure to the AI theme, but broadening out from the Mag 7 that people probably already had exposure to, because we weren't really seeing a equivalent inflow into areas such as Europe or UK. Europe does have a couple of companies involved in the AI supply chain, but less so than Asia and emerging market funds. So I think if it was just a general desire to broaden away from the US and technology, I would have expected to see more inflows into some of those other broader areas, such as Europe or the kind of broader fund of funds global investment trusts that we're seeing outflows.
And that hasn't mostly happened, as you say. Well, it's interesting. I guess people are more aware now that AI and chip makers are a particularly high proportion of emerging markets, which a lot of people may not have realized how significant those three companies in Korea and Taiwan and so on, they account for more than a quarter of the emerging markets index, or did anyway, until they started to see the sell-off more recently. The other thing I picked up looking at the year to date, you put some interesting numbers around the buy to sell ratios of individual trusts. And it's interesting to try and interpret some of those. So what you've got is the ratio between retail buying and retail selling, which gives you more of a clue of what people are really looking for. And so just looking down the list, obviously there's some who have been involved in situations where Saba's been involved and there have been tender offers. So things like Impacts Environmental and Edinburgh Worldwide. I imagine part of that has been people selling before the tender offer. Those figures don't include the tender offer, or do they? I would be interested to know what you think about that.
No, so those figures wouldn't include the tender offer because the figures just show the regular daily trades through what's called the RSP, the retail service provider. So just people trading through there.
So that's people sort of selling out before the tender, presumably.
Yeah, before the tender and just generally around the whole uncertainty regarding the Saba situation, I think. Yeah.
Indeed, because not many of the original investors have stayed with the rump of Edinburgh Worldwide now. But interesting enough, we still don't know for sure exactly where the future of those two trusts is going, even though Saba won the vote and booted out the existing directors. This is the case of Impacts Environmental and Edinburgh Worldwide. We still don't know exactly where the management of those contracts is going to go, do we?
No, so for Impacts Environmental Markets, the new board was appointed in June. So Saba nominated directors were appointed and the incumbent board was fully replaced. Saba owns about 32% of shares there. And early this month, the new board, Saba's nominees, announced that it was serving notice on Impacts Asset Management as manager. So they said they're going to run a full review process, inviting new managers to put forward offers. We don't know whether Saba will put itself forward, but I wouldn't be surprised to see that they do that and potentially propose a change of strategy to investing in closed-ended funds. They haven't explicitly said that they would do that, but when the new board was appointed, they immediately put out an announcement urging the directors to serve notice on impacts and begin a new search. The other one you mentioned, Edinburgh Worldwide, again, the new board that Saba nominated was appointed in May. We haven't seen the board say that they have served notice on Baillie Gifford as manager, but in that case, Saba has explicitly said that if there was to be a search for a new manager, they would put themselves forward and propose a change of strategy. But I expect nothing to happen there until after the expiry of the SpaceX lockups, because the new board is committed to having a tender offer post that expiry, so it's able to sell at least a proportion of its shares and conduct a tender offer. So would expect potentially a change of manager after that, although the timing of that is uncertain.
Yeah, so Saba obviously have said in general terms they very much want to take on at least one of these trusts to run it and do more of what they've been doing, basically activism in the UK investment trust sector. But it hasn't actually happened yet. We have seen this consultation by the FCA, which looks clearly designed to try and stop people like Saba doing what Saba has done in those two cases quite so easily anyway in future. That consultation runs, I think, until around the end of the year or something like that. But we don't yet know whether that will come in time to affect those two situations. Am I right about that?
I think it is probably too late for those two situations, because the main proposals that the FCA is putting forward would be around recognising that potentially those directors are not independent of a large shareholder, whereas they've obviously been and kind of changing potential caps on the ability of a large shareholder to vote. Whereas obviously for Edinburgh Worldwide and Impacts Environmental, it's already happened. And for Impacts in particular, the notice has already been served. But it could help in those two situations, and definitely for the wider sector, help to protect shareholders from any similar situations. So the proposals include preventing a director who's not independent of the proposed investment manager from voting on a board decision to appoint a proposed manager. And they've explicitly said that a director would not be considered independent where they have been appointed following nomination by the proposed investment manager. So, for example, in these situations, Saba, if they were the proposed investment manager, none of the board of Impacts or Edinburgh Worldwide would be able to vote on them being appointed as manager because they had been appointed to the board.
So it's probably a case in those two cases of closing the stable door after the horse has bolted, but the general principle being, which was an anomalous situation, I think, that you can't just use a 30% shareholding to take advantage of shareholder apathy, I guess you call it, to force through changes and appoint directors, even though you never actually convinced the majority to vote in favour. And that does seem like an anomalous situation. So that's interesting. I've noticed a small announcement from Montanaro UK Smaller Companies Trust. I don't know if you saw that, what they have been saying about making a change to their articles, which I think is also designed to have an impact. They've obviously, as a trust where Saba has a big shareholder, and essentially Saba disappeared, but might be coming back. Is that right?
As far as I'm aware, they don't have a disclosed shareholding at the moment, but I think it is one where Saba have been in and out over time. So Montanaro UK Small Companies proposing amendments to its Articles of Association, and that would include ensuring that there's a clear procedure in the event that there are insufficient directors following directors failing to be reappointed at a general meeting. So essentially, at the situations we've seen at Impacts Environmental Markets and Edinburgh Worldwide, the entire board ceased to be re-elected, and they're proposing some articles to prevent that happening, or ensuring there are safeguards in place that there are no continuing directors immediately after the vote.
On the face of it, that sounds like a sensible thing to do, just for good practice. I wonder if other trusts will pick up on that and try and do the same. We'll see whether that goes through or not. I guess there must be a question mark. Saba actually having two investment trusts that are pursuing the same strategy of investing in their activism in the investment trust sector doesn't seem to make an awful lot of sense, but maybe they will, maybe they won't. They already have this ETF that is doing the same job already. And so it is quite a complicated situation. So I guess it will be interesting to watch what the directors of these trusts do. Some will say they may be a little bit tainted by having been appointed by Saba and may not be genuinely independent, but we'll see by their actions what they do. Do you have any thoughts on how that might all play out? If they took over both of them, would they put them together, do you think, or what? Have you had much contact with Saba themselves? They have been quite taciturn with many parties in the investment trust world, shall we say.
Yeah, I haven't had any contact with them really. So anything I say would just be speculation, but I wouldn't be surprised if they did become manager of both Impacts and Edinburgh Worldwide and change strategies. I wouldn't be surprised to see them merge the two trusts
together, yeah. That would seem to make sense if that's the way it goes, and if they can get both those mandates. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. There has been some mergers going on, which may or may not have been influenced by Saba's activities over the past 2 or 3 years. There's a link up between Schroeder Asia Total Return and Pacific Assets. And meanwhile, as we talked about, there's also been a tender offer at Herald, where 60%, I think, have voted to take the tender offer. and HRI Herald has now become managed by Aberdeen. What did you make of that outcome, which allows Katie Potts and her team to carry on, though not with the same kind of management structure as before?
Yes, so Herald Investment Trust was one of the original Saba targets back in Christmas 2024, I think it was. So it's been a long period of uncertainty for that trust. And I think the conclusion that they came to in the end was a good outcome for shareholders. It's now provided some clarity on the future, and shareholders can continue in the investment trust under the same pretty unique strategy focusing on small cap technology companies. As part of the overall deal, Saba fully exited Herald under the tender offer. They took their holdings in specie as well, so that helped mitigate potential liquidity issues if they'd had to completely sell down the entire of the tender pool. Saba has also signed a standstill agreement until 2029, so again provides more clarity on the future of the investment trust and enables the team to just concentrate on managing the fund under the strategy rather than worrying about shareholder activism from that particular shareholder. I think the move to Aberdeen should be positive at the margin as well. It should help increase marketing effort, which could help a re-rating.
Herald is surviving and is going to battle on. It's much smaller than it was. It's come down in size to 600 million or something like that market cap, and it's back now trading at a 10% or so discount, I think. It always has traded at a discount, I don't know, for various reasons. But one general view is that Katie Potts and her team have spent most of their time doing what they're being paid to do, which is to look after the stock picking and managing the portfolio. They've never been particularly prominent in marketing to the sort of broader world. And that's something, obviously, Aberdeen has a very good window on that, having been a well-established large fund management group. So you would think that might enable them to potentially get more investors, and that might allow them to break out, do you think, of this permanent discount or not?
Yes, I think so. I mean, it has re-rated in the last few months, I think, but I think there is potential for a re-rating, or for at least to trade at a narrower discount than it has historically, because, as you say, it now has a much wider supportive marketing and sales team behind it, and the outlook is more certain in terms of the shareholder base.
And Aberdeen, of course, also owns one of the largest platforms, Interactive Investor, which, though it's sort of hands-off in that sense, it may help them reach a broader market. So that'll be interesting to watch how that one develops. On the Saba front, on a much smaller scale, one of the companies they've got a stake in, which they've been increasing their stake in, I think, is Brown Advisory US Smaller Companies. They're doing a strategic review, which is often a code word for coming up with some merger or wind-up or similar proposal. Yeah, it's a relatively small trust, hasn't done particularly well. Any clue what may happen to that one?
I think announcing a strategic review was the right decision from the board. It is something we are seeing more and more often, with investors increasingly focused on size and liquidity, as well as discounts and performance, boards being more active in responding to these shareholder concerns. So it wasn't a huge surprise to see the board announce a strategic review there. As you said, it is pretty small. It has underperformed the benchmark over a number of time periods, and it has traded at a sustained discount. So I think the board did need to do something. We'll see what the outcome is, but as you say, I think they will propose something. I don't think the strategic review will just end in everything's fine. So I wouldn't be surprised to see it either merge with another investment trust or just introduce a wind down. It already has a 100% performance tender offer that would be triggered in 2028. And at the moment, it is looking like it would underperform over the period and trigger that tender offer. So I assume the board would already be looking out a couple of years and essentially be thinking that they'd have to propose a 100% tender offer then, so they could bring that forward and then see if it's still viable to continue after that. So there are a number of options, but I would expect to see something relatively significant come out of that review.
It'd be interesting to see, yes. I mean, one of the questions will be, well, does the investment trust sector need a US smaller companies trust, essentially? That's an interesting question at the moment. Obviously, we know the US market's been dominated by some very large cap companies for quite a long time now. So you might think that that's a case for wanting to keep some option to expose yourself to US smaller companies. On the other hand, you might think that in most people's portfolios, by the time you've drilled down, that's going to be a pretty small part of the overall mix, and you might as well just have a global smaller companies mandate or something like that. Do you think there's a case for a US smaller companies mandate in the investment trust sector world?
There are only two at the moment. So if Brown Advisory does disappear, then there would just be one, which is JP Morgan US smaller companies? It's an interesting question. In general, smaller companies are well suited to the investment trust structure. And US smaller companies are a bigger part of global benchmarks than UK smaller companies, where there are 17 investment trusts. So you'd think, if anything, there's maybe more scope to have investment trusts focused on US smaller companies than UK smaller companies. So I think it is potentially an interesting area, but in general, something that we are looking at is ensuring that investment trusts do make use of the structure and they aren't just doing something that you could do in an open-ended fund or even an ETF. So that has to really use the strategy. So use the structure in the strategy, whether that's investing in illiquid assets or utilising gearing or potentially introducing an enhanced dividend, things like that.
Yes, I mean, there's always a trade-off between those benefits and the issue of liquidity, which we mentioned already on the other side. We have continued to see trusts adopting enhanced dividends. I don't know if you've looked recently at how those trusts that have adopted it, how they've performed since. It seems to be popular with investors, particularly private investors, even though you can argue whether it actually theoretically makes an awful lot of sense, because it should be really, most things are just a total return calculation. What do you think about that trend? Do you think it's going to continue?
I think in general, the idea of adopting an enhanced dividend policy has become more accepted by the wider market, particularly institutional investors. Initially, I think there was some skepticism around it, particularly around the tax implications, but I think it has become more accepted and is seen as a way of potentially helping the rating by increasing interest to retail investors and making use of the investment trust structure, kind of utilising a lever that investment trusts have that open-ended funds don't. We have seen mixed results in terms of the impact that it's had on the rating, and it's always difficult to split out whether it was the enhanced dividend that has led to any re-rating anyway, because often it has been accompanied by a change in performance or its sentiment towards the asset class. It's difficult to always pick that out. But we have seen a number of cases where it has looked to help support the rating. And I do think it can be a really good way to offer a yield while not constraining the investment managers and ensuring that they can maintain as wide an investment universe as possible and pick the best stocks from a wider investment universe. But I think it also does depend on the asset class that it's being used in. And investors should be aware that if it is a dividend based on year-end NAV, then there is potential for that dividend to be cut if the NAV does fall over the year, as opposed to traditional equity income investment trusts that aim to grow their dividend every year.
As I said earlier, I mean, trusts that offer a yield are particularly in favour at the moment. The list of those that are trading around par or at a premium, there aren't many, of course, these days, but there's around 20, I think, are trading around par or at a premium. They're mostly dominated by trusts that have a significant yield, one or two other outliers like Rockwood Strategic and one or two specialist vehicles, but that's definitely a trend, isn't it? I was going to come back on that context and talk about commercial property because you mentioned that. There has been one or two developments there. There is an ongoing transaction involving alternative income REIT, where there's been a proposal from AEW UK and also a rival bid from Glenstone, which is a large shareholder in alternative income REIT. That's playing out. We've also seen Schroeder European Real Estate announcing a wind down that's going out of business. And there's a transaction involving residential secure income, which is being proposed to merge into something now called Living REIT. It used to have a different name. And meanwhile, we've also seen some good performance from Tritax Big Box. So what do you think is going on in the sector now? This consolidation you mentioned earlier, that's still ongoing, therefore. So we are going to end up with a very, very small niche sector, aren't we, the way things are going? Are any of those deals I mentioned a surprise to you?
I think the alternative income REIT deal is an interesting one. We don't often see these kind of takeover battles in the investment trust sector. So as I mentioned, Glenstone REIT owns about 25% of alternative income REIT's shares. So it's a large shareholder. They're attempting to take over the trust, but there's also a competing offer from AEW UK REIT, and that is the offer that the board prefer. And they've urged shareholders not to take up the Glenstone offer, but we're still awaiting whether AEW will make a firm takeover offer. They have until the 28th of August to do that. So we'll see if there's any developments there. But Glenstone have said that it would vote against that deal. And being a 25% shareholder, that obviously has the potential to block that. So that might impact AEW's decision to make a firm offer there.
on paper, the offer from AEW, if it was to go through, that is worth more than the offer that Glenstone have made, assuming that AEW shares continue to trade the way they are.
Yes, yeah, it's a better offer in terms of pricing, but it's an all-share deal, so it will be subject to changes in the AW share price. And it also seems to have a better certainty of completion because it would be an all-share merger, essentially, and shareholders would maintain their investment in AW and have that liquidity going forward.
Yeah. So when is that one going to complete?
So AW has until the 28th of August to make a firm offer or not. So that could extend the deadlines, I think, if it does. And then the Glenstone deadline is 4th of September.
Right. So there's basically some haggling to be done, or it just won't happen if they continue to block the deal.
Yeah.
Yeah. Okay, that's good. And then in terms of the sector overall, I mean, Schroeder European Real Estate, that's going to disappear.
Yeah, that one wasn't really a surprise that it proposed to manage wind down. It was one that we had actually flagged earlier in the year as a likely candidate for corporate activity, given its pretty small size with only £80 million market cap, and it had traded on a discount of wider than 30% for the majority of the last 2 years. And we also noted that Phil Redding was to be appointed chairman with effect from March, and he was previously CEO of Tritax Eurobox, another investment trust which ended up being sold. So we expected him to review the fund strategy and engage with shareholders there. So it doesn't really come as a surprise. And we think that the decision to enter a managed wind down was probably a sensible decision. I would assume that they potentially looked into the possibility of selling the portfolio or the fund as a whole, but its small size and diversification across a range of countries and asset classes probably made it difficult to find a buyer for the portfolio as a whole.
Just came back to your sector expertise. I wonder what your thoughts are about commercial property generally. I mean, do you think there may be some sort of seller regret in due course? If we look at the kind of big picture on commercial property, it obviously does offer a yield, a real yield normally. Do you think it's an attractive time to be doing this? Even Segro has now been bid for, Slough Estates as was, which is a very big company. There does seem to be a lot of corporate and private equity interest in commercial property at the moment, but the investment trust sector has virtually disappeared. So do you think there'll be time where people say, if only we had some vehicles we could use to get back into this asset class?
Yeah, I really wouldn't be surprised about that. I think there is an element of frustration from the managers of property investment trusts that now is a particularly opportune time to invest in property, but they're trading at discounts, so aren't able to raise more money. There was a fund that tried to launch, I think, last year, highlighting the fact that it was an opportune time to invest in commercial property, but because of a lack of positive sentiment, they weren't able to raise that. And I think it's now a private vehicle. So yeah, it does seem to be a bit of a shame that when the asset class is out of favour, which I think is primarily due to interest rates, it means that it's actually a good time to invest. And the investment trust structure is obviously positive that the funds don't have to sell assets at this time, but the fact that they are trading on a discount and it would be dilutive to issue new shares and raise money, alongside the fact they probably wouldn't be able to because of the lack of demand, means that they can't grow their portfolios and invest in these attractive underlying opportunities.
Yeah, so I think that might be a source of future regret. I just wanted to go back finally to the net buying and selling that you track. The two which have got the worst ratios, in other words, they've got far more sellers than buyers year to date, were Midwind International and Aberdeen UK Smaller Companies Growth Trust. Midwind obviously is a large quality value manager, same kind of Terry Smith time approach, Fund Smith approach, very much out of favour. And then obviously there was a manager change there not so long ago. But Aberdeen UK Smaller Companies Growth, I mean, that surprised me a little bit because that's been around a long time, good long-term performer. What do you think in those two cases? What do you think's been going on there?
I would say probably a lot of it is due to recent performance having disappointed, particularly in the case of Aberdeen UK Smaller Companies Growth. It is the worst or second worst performer in the pretty big UK smaller companies peer group over the last 1 year and has underperformed the benchmark over the kind of last 1, 3 and 5 years. It has attempted to kind of review performance, and the managers are looking to introduce some enhancements to the strategy while ensuring that there's no style drift. So I think that they are making some changes there, and if performance does turn around, hopefully that should lead to increased investor demand and could see a re-rating there. On Midwind International, again, performance has been reasonably disappointing over a range of time periods. And I would also say that I think it has a zero discount, or I think it's 2% discount policy. So the board will be offering that liquidity to shareholders that do want to sell, which might be influencing decisions there.
And then on the positive side, I mean, top is Fidelity Emerging Markets, which has been performing very well. So benefiting from the emerging market shift, but also the fact that it's recovered very well after a tricky start under Fidelity when they took over Genesis 2 or 3 years ago. That's at the top of the list. Then I'm just looking at the other names. BlackRock American Income, that's an interesting one. Schroeder Japan Biopharma Credit, that's a yield debt fund. And then Vietnam Enterprise, that's been positive buyers, but that's more recently had a very tough time, has it not?
Yes, it has. And it has committed to holding a number of tender offers. They're not 100% tender offers, they are limited, but we've potentially seen some buying from retail investors ahead of those tender offers, knowing that there will be some form of liquidity opportunity.
The last one, I think there was a 70% take up and only 10% available.
Yeah.
Which suggests that there may be some disappointed holders there. Out of the other names I mentioned, anything strike you about that list? I mean, it's a very variegated list, which is what you'd expect.
Yes. I don't think there are any kind of real themes to draw out. Although one of them, you mentioned BlackRock American Income. I think that's going to be an interesting one to watch. That introduced a different strategy a few years ago, I think it was. So it's essentially utilising AI in its investment process and looking to be a bit of a benchmark plus type of return. So yeah, doing something very different. And we have seen the share price respond positively, as well as good NAV performance from it as well. So that change of strategy seems to be something that shareholders do like, and it's now actually trading at a premium. So yeah, it's pretty small, but it'll be interesting to see if that does continue to perform well and if any other investment trusts follow suit.
They have a quant strategy with a sort of black box. We've had those in the past. They haven't always ended well, shall we say, but at the moment it seems to be working. But an interesting development. I mean, I'm sure we may see more of those in due course. So that brings us pretty much to the end. Emma, thank you very much. I mean, there are lots of interesting discount opportunities out there, I think. There are some trusts which, to me at least, seem to be trading at anomalous discounts. I don't know whether you agree with that. Or at least there are ones that are trading at discounts that should present opportunities or could present opportunities. And, some of them are not surprising. Some of them are more surprising. Something like Pershing Square Holdings at a 33% discount. Interesting to keep an eye on RAT Capital. That has done a tender offer as well recently, which was interesting. They're trading on a 20% discount, which is better than they have been. And those are two big trusts. How would you explain those two?
So Pershing Square Holdings is a US equity investment trust managed by Bill Ackman. It has always, or in recent years, traded at a wide discount. The board are very aware of this and they have done a number of things to resolve this. But I think it is actually trading tighter than it has done. But again, more recent performance has struggled. So I would expect that we'd need to see maybe a turnaround in performance for the discount to narrow further there. As you mentioned, Rick Capital Partners held a tender offer and intends to continue with its buyback program. The board, again, I think are acutely aware that the discount is too wide, so would expect them to continue to attempt to narrow that discount. Essentially, what happened there was some concerns over the size of the private portfolio within it a few years ago, and the discount widened sharply, and we haven't seen it recover since. But I think, as I said, the board and the management team are aware, and it has performed pretty strongly. So yeah, we could see some re-rating from there, even though it is narrower than it has been for the last few years.
And finally, of course, the burning question for many at this hour would be Scottish Mortgage 11% discount, Polar Capital Technology and Allianz Technology both nudging 10%, maybe 9%, depending on what number you look at. Debate goes on, doesn't it? I mean, we don't know whether what we've seen has been a sort of AI scare, I guess, in the last few weeks. We don't know. But historically, those have been pretty reasonable ratings for those trusts, if you buy the story.
Yes, and I think both Polar Capital Technology and Allianz Technology, they're in the top 3 best NAV performers over the first half of 2026. So they have been performing strongly. Their share prices just haven't kept up. But clearly, yeah, there is a big AI question there. But I think if you want to have some exposure to the theme, then it's a good way to get some kind of diversification across the technology spectrum via an investment trust. And then on Scottish Mortgage, I think potentially there's some concerns around the size of SpaceX within its portfolio now. So it's over a quarter of Scottish Mortgage's portfolio. But I would expect the managers to trim at least some of that for portfolio management reasons as the lockups expire. So we could see some re-rating after the portfolio is potentially rebalanced to something that investors are happier with.
Yes, it will be interesting when the lockups expire and they're in staggered phases over the next few months. Interesting to see whether the decision that the board of Edinburgh Worldwide made last year to cut their holding in SpaceX on diversification grounds, it'll be interesting to see at the end of the day whether that was actually, in hindsight, prudent or not prudent. It will be one of the many unanswered questions that we might have to look at in the future. So that was Emma Bird, the head of investment trust research at Winterfloods, now part of Marex Financial, talking to me on Thursday.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.